G'day everyone, welcome back to Pete's Investing. Today is June 9, 2023. This is the US S&P 500 market update. On the weekly, we're still in a bullish momentum. You can see there it's doing quite nicely. On the daily, it's broken down into a neutral, so cautiously going long. And on the hourly, on the daily, I'll show you a bit of a divergence that's probably failed, but on the hourly, I'll show you a divergence that's currently playing out. So let's look at the weekly first. For those new to the channel, we look at the triple moving average of the price chart and we compare it to the moving averages of the CCI 150. And if they're aligned, it gives us a bullish signal, as they are now. Otherwise, a neutral or even a bearish signal is given. So we take primarily on the smaller time frames, like the hourly, we take predominantly trades to be more confident, aligning with the weekly and the daily. Likewise, on the daily, you'll notice here it's the moving averages of both the price chart and the CCI are not aligned, so it's giving us a neutral signal. But more importantly, looking at what we've got here is it had a resistance here that was broken, and it hit this new resistance at 42.90. It's currently sort of struggling to break above that. I did also draw this key, this diagonal, these two diagonals crossing up and down, but as well. So the price, if it does collapse, it may well come and collapse and rest on this lower diagonal, but that's way off at the moment. And at the moment, it's still rising and it's sort of following that upward moving diagonal. Now, I also did draw this divergence that was playing out, and it's actually, I think it's probably failed. So if you look at it from that point, for example, from there to there, you can see there it was showing a bearish divergence. Actually, that's not right. It was actually showing it there. That was showing a flat divergence. And that same area was showing was showing a bullish divergence. Now that failed after this breakout to the upside on that bullish candle, and so I'm going to remove that just to avoid confusion. And that was going to be our initial target area had that worked. But I'm going to leave that channel and that target area in there for the moment. I don't think it's going to work, but let's leave it there for the moment. On the hourly, you can see there we've got this, and the divergence on the hourly are independent and separate to the daily or even weekly divergence. So this is an independent divergence. You can see there's a bearish divergence on the CCI versus a bullish divergence on the price chart. Now that, again, the price is sort of leveling out there, but the CCI is still falling off. So what we're looking at here potentially is if this breaks to the downside, and what we do first off is we draw a channel down to the lowest point of that divergence range, and then if we zoom out, we draw a Fibonacci level between that recent low. Do that again. That recent low, and it doesn't like me doing these Fibonacci levels. Here we go. To that high, which is where we are at the moment. So what we look at doing is when it breaks below that, we're looking at a target area probably around that level there, around a 50% level. So if it does continue to the downside, if that CCI continues to the downside and the price drops, we're going to look at that potentially as our new target area. And that there, just realign that. That's not quite accurate. That's going to be between the 50% and the 61% level. So that'll be our initial target area. Now that's a bit of a stretch. I'm not telling you to trade that. I'm just sort of trying to map out where that divergence may fall if that works. If this CCI breaks to the upside like it did on the, then we're going to see potentially the price rise as well like it did on the daily, in which case the divergence has failed. So they don't always work, but a lot of the time they do as well. So that's where we are at the moment. Also, if I zoom out, you can see here I've got a back test for a long program and a back test for a short program. And the way to avoid the average downs, you can see that it's averaging down there and there. And the average down, we don't use stop losses, we add to the positions. The way you avoid those average downs is, again, making sure you trade directly in the direction of the weekly and the daily when they're aligned. So during that period there, for example, when that price was declining, that was between April 22 to there. So if I zoom out to April 22, in that period there, likewise, that period there, you can see there's no long positions on the weekly, and there are no or very limited long positions on the daily. So to be more confident, trade only direction of the weekly and the daily trends as you would have traded primarily short positions there. and you would have traded primarily short positions there as well when the daily and the weekly align. Hence the profitability during the short positions of that period there. So to understand how to trade this and other trading strategies, reference the links in the description below. Subscribe to my Patreon page, where we also scan for stocks, currencies and commodities. Thanks for watching. Subscribe, like and share the channel. See you in a future video.